In this video, we'll show you about the Forex market and who control Forex market, how Forex market works, how much liquidity Forex market has, about international parity, economic indicators and Forex terminology. The foreign exchange market, Forex, FX, or currency market, is a global decentralized or over-the-counter, OTC, market for the trading of currencies. This market determines foreign exchange rates for every currency. It includes all aspects of buying, selling and exchanging currencies at current or determined prices. In terms of trading volume, it is by far the largest market in the world. The main participants in this market are the larger international banks. Financial centers around the world function as anchors of trading between a wide range of multiple types of buyers and sellers around the clock, with the exception of weekends. Since currencies are always traded in pairs, like Euro USD, GBP USD, JPY USD, the foreign exchange market works through financial institutions and operates on several levels. Behind the scenes, banks turn to a smaller number of financial firms known as dealers, who are involved in large quantities of foreign exchange trading. Most foreign exchange dealers are banks, so this behind-the-scenes market is sometimes called the interbank market. In a typical foreign exchange transaction, a party purchases some quantity of one currency by paying with some quantity of another currency. The modern foreign exchange market began forming during the 1970s. The foreign exchange market is unique because of the following characteristics. Its continuous operation, 24 hours a day except for weekends, i.e., trading from 2200 Coordinated Universal Time on Sunday, Sydney, until 2200 Coordinated Universal Time Friday, New York. The foreign exchange market is the most liquid financial market in the world. Traders include governments and central banks, commercial banks, other institutional investors and financial institutions, currency speculators, other commercial corporations, and individuals. According to the 2019 Triennial Central Bank Survey, coordinated by the Bank for International Settlements, average daily turnover was $7.5 trillion in April 2022, compared to $1.9 trillion in 2004. Of this $6.6 trillion, $2.1 trillion was spot transactions and $5.4 trillion was traded in outright forwards, swaps, and other derivatives. Foreign exchange is traded in an over-the-counter market where brokers, dealers negotiate directly with one another, so there is no central exchange or clearinghouse. The biggest geographic trading center is the United Kingdom, primarily London. In a fixed exchange rate regime, exchange rates are decided by the government, while a number of theories have been proposed to explain and predict the fluctuations in exchange rates in a floating exchange rate regime, including international parity conditions, relative purchasing power parity, interest rate parity, domestic Fisher effect, international Fisher effect. To some extent, the above theories provide logical explanation for the fluctuations in exchange rates. Yet these theories falter as they are based on challengeable assumptions, e.g., free flow of goods, services, and capital, which seldom hold true in the real world. Balance of payments model. This model, however, focuses largely on tradable goods and services, ignoring the increasing role of global capital flows. It failed to provide any explanation for the continuous appreciation of the US dollar during the 1980s and most of the 1990s, despite the soaring US current account deficit. Asset market model views currencies as an important asset class for constructing investment portfolios. Asset prices are influenced mostly by people's willingness to hold the existing quantities of assets, which in turn depends on their expectations on the future worth of these assets. The asset market model of exchange rate determination states that the exchange rate between two currencies represents the price that just balances the relative supplies of, and demand for, assets denominated in those currencies. Economic factors include a. Economic policy, disseminated by government agencies and central banks. B. Economic conditions, generally revealed through economic reports, and other economic indicators. Economic policy comprises government fiscal policy, budget, spending practices, and monetary policy, the means by which a government's central bank influences the supply and cost of money, which is reflected by the level of interest rates. Government budget deficits or surpluses. The market usually reacts negatively to widening government budget deficits, and positively to narrowing budget deficits. The impact is reflected in the value of a country's currency. Balance of trade levels and trends. The trade flow between countries illustrates the demand for goods and services, which in turn indicates demand for a country's currency to conduct trade. Surpluses and deficits in trade of goods and services reflect the competitiveness of a nation's economy. For example, trade deficits may have a negative impact on a nation's currency. Inflation levels and trends. Typically, a currency will lose value if there is a high level of inflation in a country or if inflation levels are perceived to be rising. This is because inflation erodes purchasing power, thus demand, for that particular currency. However, a currency may sometimes strengthen when inflation rises because of expectations that the central bank will raise short-term interest rates to combat rising inflation. Economic growth and health. Reports such as GDP, employment levels, retail sales, capacity utilization and others detail the levels of a country's economic growth and health. Generally, the more healthy and robust a country's economy, the better its currency will perform, and the more demand for it there will be. Productivity of an economy. Increasing productivity in an economy should positively influence the value of its currency. Its effects are more prominent if the increase is in the traded sector. Controversy about currency speculators and their effect on currency devaluations and national economies recurs regularly. The best way to get started on the Forex journey is to learn its language. Here are a few terms to get you started. Forex account. A Forex account is used to make currency trades. Depending on the lot size, there can be 3 types of Forex accounts. Micro Forex accounts. Accounts that allow you to trade up to $1,000 worth of currencies in one lot. Mini Forex accounts. Accounts that allow you to trade up to $10,000 worth of currencies in one lot. Standard Forex accounts. Accounts that allow you to trade up to $100,000 worth of currencies in one lot. Ask. An ask, or offer, is the lowest price at which you are willing to buy a currency. Bid. A bid is the price at which you are willing to sell a currency. Contract for difference. A contract for difference, CFD, is a derivative that lets traders speculate on price movements for currencies without owning the underlying asset. Leverage. Leverage is using borrowed capital to multiply returns. The Forex market is characterized by high leverages, and traders often use it to boost their positions. This is for now. If you like this video, please subscribe the channel.